When it's time to go out and raise capital, you should consider one principle and keep it in mind, and that is the more money you raise at lower, earlier stage valuations, the more of your company you're going to give up. It's a simple math equation. So when it's time, and you're an early stage company, you're still in the testing, development phase, and the MVP phase, you're going to have limited amounts of ways to raise capital. This is pre-revenue, oftentimes. And so what's available to you at that time? Friends and family will often be willing to lend you money in some sort of debt structure, which are easy to put together. You can value your company and take a swing at that, which is a little difficult sometimes. But if you're willing to put a valuation on your company and you can get a good match with an investor, you can get a priced equity round done. And if you're somewhere in between, where you're not sure what the valuation might be, you can consider a convertible instrument, which means it'll start and look like debt in the beginning, but the intent is that that will become equity at some future priced round. Those are all very common. You'll hear those called convertible notes, or something similar to it is something called a SAFE. Now, once you move into later rounds, equity rounds, growth rounds, called by a variety of different names, you'll find some additional structures available to you. Now you'll find yourself being able to attract institutional investors. They oftentimes will invest through venture debt, as an example, which are sometimes a multiple of your revenues and are much easier to get once you've begun developing revenues and you see growth in your revenue. Once you've moved out of the earliest stages and you're in more of the growth stages of raising capital, you've got a couple other structures that then open up to you. A really common one is venture debt. Institutional investors are willing to put money into your business in the form of debt, and it's oftentimes a structure that looks like a multiple of your MRR or your ARR. Those are very common structures that now are available to you once you're in and moving, the business is growing, you've proven out the product. Additionally, you can attract institutional investors in equity type rounds. And still available to you are convertible notes if you aren't quite ready to price the next round and you want to bridge to that next price event.
So how do you know once you're ready to go and approach the more sophisticated investors? I like to call this that you've cracked the code. What that means is you understand who your market is, what your price is, and you've figured out how to sell and go to market, and you've demonstrated that you have customers and growth. Once you get to this stage, then you can go to the more sophisticated investor, and they're really more focused on you've solved those problems or cracked the code, and now they're just helping you execute the plan that you've developed.
These are really complicated times to go raise capital, whether it's debt or equity, and more than anything else, I think it's really important to go get sophisticated, capable, experienced CFO help and legal help.